story of the UK is an economy that has got real momentum.
What is broken can be repaired. What is ruined can be rebuilt.
UK inflation is becoming much more homegrown.
We have huge potential as an economy in the UK.
This is a time to tell Israel there is a path to peace.
Our plan for the British economy is working, but the work is not done.
You're listening to Bloomberg UK Politics. I'm Yuan Potts.
I'm Lizzy Burden.
And I'm Caroline Hepker. Welcome to the programme. I don't know about you, but I'm getting to the point in the year where I wonder about how I did at work, whether decisions that I made paid off, whether it was the hard graft that gave me the dividend, or whether I actually made the right decisions when I was under pressure. And that sort of got me to thinking about Rishi Sunak and the big announcement that he made at the Tory party conference where Lizzy, you and I were reporting from earlier this year. The big announcement, a little refresher, here it is.
I am ending this long-running saga. I am cancelling the rest of the HS2 project. And in its place, we will reinvest every single penny, £36 billion, in hundreds of new transport projects in the North and the Midlands across the country. This means £36 billion of investment in the projects that will make a real difference across our nation.
So Rishi Sunak there, scrapping the flagship rail plan. Why am I thinking about that now? Well, because it's about those long-term decisions for a better future. Michael Saunders, the former Bank of England official, says that it is something that the Bank of England did, quantitative easing, that actually cost just as much as actually having gone ahead with the HS2 programme, and that is QE, quantitative easing.
Yeah, it's absolutely a phenomenal claim, isn't it? Just a quick reminder of what QE is. Basically money printing by the Bank of England, first deployed by central banks in the wake of the global financial crisis in 2008. They issued billions of pounds of new money and used it to buy bonds. That kept the market functioning and kept interest rates on those bonds low. And that eased the way for the UK and other governments during the pandemic to issue lots and lots of debt, which did help us get through those troubling times.
Yeah, but you have to ask, how much was the opportunity cost, or how much would it have been if you didn't have QE, or if you don't go ahead with HS2? How much growth could you have that you lose by not spending that money?
But it's very pointed, isn't it, that Michael Saunders, who's basically an economist, is trying to speak the language of government by saying, look at something that the Bank of England does, which actually most voters out there are not clued up on, but look at how much this exit of QE that was an emergency programme is actually costing ultimately taxpayers. How does he translate that? He says, look, this is basically the cost of HS2.
Yeah, the other thing we haven't fully got to the bottom of is how much of the current inflation we're dealing with at the moment is to do with QE. Central banks around the world issued very suddenly $10-11 trillion of money. And when you create loads of money very, very quickly, economic theory suggests that's going to create a rise in prices. So, some of the inflation pain we have suffered is undoubtedly because of those decisions by the central banks.
Yeah, it's an issue that often comes up at the House of Lords Economic Affairs Committee. We know that they've just written that scathing report about the Bank of England recently, and not to forget that former Governor Mervyn King sits on that committee. But talking about decisions made in a crisis that have gone sour, it reminds me of what you were discussing yesterday, the Future Fund, and how taxpayers face this £300 million bill because of what was once seen as the lifeline for startups during the pandemic, the brainchild of Rishi Sunak, as it was called at the time.
Yeah, well, I suppose it's, marry in haste and rue at your leisure, perhaps, if that's the way that you see it. I mean, others will say that without these programmes, actually, we would have been, faced much greater difficulties because of the financial crisis and then the pandemic and so much more. But look, let's go to the inflation data, though, because that's another point that we've had out today. Again, very politically significant, Lizzy.
Yeah, Caroline, you've got your clip. Here's mine from our UK Markets Today editor, Dave Goodman.
Pretty stunning reading, wasn't it? I sit next to Connor, who does our squawk on Bloomberg, and I think everyone heard me shout "wow" loudly in the background as he was reading out to people. 3.9%. No one. We Bloomberg had surveyed 35 economists. Not one of them saw a reading below 4.2%. So that kind of shows you how much of a shock this is in terms of a downward surprise. It's the biggest since February 2021.
So in the words of our colleague Tom Keane, this was a wow statistic, this inflation reading this morning. A shocker to everyone. Dave's actually with us in the studio for more analysis. Dave, how could it be so shockingly good?
Well, if you think I was excited, you should have watched Mark Cudmore on TV. I've never seen someone so excited by inflation.
He blew the doors off, yeah.
Oh, completely, yeah.
This is very Bloomberg, isn't it?
Yeah, watch it on Twitter if you can. I think it's stunning how quickly it's come down based on where we were in the summer. In the summer, the UK was this big inflation outlier, almost a pariah, that people were saying, why has the UK got stickier inflation? Why is it so bad there? Now, it's just a few months on, but the situation feels really, really very different, and the UK is coming back towards the pack, and that has big implications for the Bank of England, because even last week it was looking like a bit of a laggard in terms of what it might do next year, what it might do on rate cuts. Increasingly now, I think it's just seen as part of the general trend towards rate cuts, and now we're seeing five rate cuts, maybe even 6 priced in.
But hang on, how can we all be cheering 3.9% inflation? And it also doesn't mean that prices in the shops have come down. I mean, it's not like voters are going to be delighted about how much they're spending on their Christmas gifts this year, or their table in terms of, festive food. Like, we have still had that big run up in inflation. So how come people are so pleased to see it, still quite high? Yeah,
totally. And the situation is obviously a lot worse in terms of prices than it was going into the pandemic and even coming out of lockdowns. I think it's just obviously the pain of where we were last year and how people were seeing 20% increases in food prices. They were seeing obviously those huge increases in gas bills. Now we're paying those anyway. I suppose people have somehow internalised that, normalised it, and get used to that. And then the fact that they're just rising at a more normal rate now is easier to stomach.
So inflation down below 4% finally, but we're still worse than most other major economies, aren't we? Just put us in context with the rest of the world.
Yeah, we're still worse than most places in the world. I think we're coming back more towards the pack now, as I said earlier, that there's a bit more scope to see us in a more normal position. A big part of why the UK has been different is just to do with how energy prices kind of filter through. A lot of other countries feel the heat from energy prices earlier, and then when energy prices drop, it comes off quicker. Because we've got the energy price cap, it kind of slightly distorts the data in that we get these increases or decreases in stages on particular months, and that really impacts things. So I think that was why we looked so terrible earlier this year.
So that's the economics, but of course it is political, because Rishi Sunak's top priority at the start of the year was to halve inflation by year end. Here is the Chancellor Jeremy Hunt's reaction to this morning's data.
A year ago, inflation was 11.1%. Now it's fallen to 3.9%, the lowest for over 2 years. And that shows the government's plan for the economy is working. But nonetheless, it is very tough for a lot of families. And that's why from next month, national insurance contributions will go down by 2%. That's worth £450 a year for someone on the average wage.
Now, what you can't see because we're a podcast is the massive Christmas tree behind the Chancellor in that clip. But nonetheless, Dave, even before the CPI print this morning, Oxford Economics said that because traders were expecting so many rate cuts from the Bank of England next year, and because the fiscal watchdog, the Office for Budget Responsibility, calculates the Chancellor's headroom based on market rates, he's going to have about £11 billion of headroom by the spring budget. So inevitably, you've had Conservative MPs clamouring for tax cuts, and we've reported inheritance tax cut is one of those that they're calling for. Just talk us through how markets reacted this morning, and therefore what the moves in gilt yields mean for headroom in spring.
Sure. I mean, there was a pretty euphoric reaction this morning to the inflation data. UK stocks really soared, led by home builders, financial services, those kind of companies. Gilt yields plunged at the open, and then we had bets on BOE rate cuts next year really gather pace. As I said, we're now looking at close to 150 basis points next year, which would take us below 4%. 1.5%, yeah. So below 4% on the BOE base rate. That all filters through into these calculations that the OBR will make. So if it was 11 billion headroom last night, it will be more this morning. So I think then obviously that adds to the pressure. What Hunt would say, and perhaps what he has been saying, is that you can't you can't use all of that to stoke more demand through tax cuts, particularly ones that don't really grow the economy that well.
Which add to inflation.
Exactly, yeah. So that's why there might still be some caution out there.
Everybody said that before the autumn statement, didn't they?
I was interested to read that our economists, Bloomberg economists, now think that inflation will hit the 2% target by May, and that is a month which has been touted as a possible election month.
Yeah, although obviously we won't find that out until June. So
well, that's true.
You have to try and think of how Rishi Sunak will think of these calculations when he's calling the election, or do you go a little bit later and hope that you get more kind of growth picking up as well? I think it's a brave politician who pegs elections to ONS data though at the moment, based on how that's been over the last year.
That's a very charitable word, I think.
That's quite a rapid drop though, isn't it? So we really think it's going to be down to 2% within 5-6 months.
Yeah, Anna Andrade said that to us on Bloomberg Radio this morning, our European economist here at Bloomberg Economics.
Yeah, that would be a pretty surprising drop, given that, let's say, where we were this time last year, where we've been in the summer. And I think what we may see is just the kind of the maths of it. I think I was talking to Lizzy after the November date, and I was saying like the drop in inflation we've seen is probably 40% the BOE, maybe 5% the government, and the rest is just simple mathematics, that like you have these high energy prices dropping out of the calculations, that drags it down. So when you have those base effects kick in, that really does lead to a quite rapid decline. But then it does mean there is a risk of we get to 2% or a bit below 2%, and then we bounce back up and everyone starts panicking again.
In the clever pod that is the Market is Today team, how seriously do you all take the risk of inflation surging back in 2024 because of all of this disruption to trade in the Red Sea?
I mean, that is a risk. I mean, we've seen a lot of these little pockets of things fly up as inflation's been coming down. Obviously, there was the situation in Israel. There's what's happening in the Red Sea now. I think they're all things that are on people's radars. I don't think it's going to be another kind of Russia-Ukraine situation where it has such a huge impact on inflation that the kind of price gains just go completely off the charts like we saw last year.
Yeah, okay, so perhaps the impact being quite different, although actually a lot of the big shipping companies are now rerouting, so it could be an issue perhaps for the future. Dave Goodman, thank you so much for being with us, our UK Markets Today editor. Dave Goodman just unpacking the inflation data out of the UK that we had at 7 a.m, and then the quick reaction from the Chancellor. And it is obviously a very significant issue for voters and for the government.
Yes, and very welcome economic news for the government, but some rather bad political news today. Now, Caroline, do you know how many by-elections we've had in this Parliament? It's been 4 years, almost exactly 4 years since the last general election.
Has it been 4 years since?
Yeah, that's unbelievable, isn't it?
Sooner than that. I know the answer, but I was pretty shocked by it.
Yeah, 20. This is going to be the 20th by-election. It all started off well for the Tories in this Parliament with Hartlepool, the iconic seat of Peter Mandelson a few years ago. The Conservatives gained that from Labour. Very rare for governments to take a by-election. But later that year, the Lib Dems gained Chesham and Amersham, and that really started the rot. Well, more bad news today. There's going to be a by-election in Wellingborough in Northamptonshire. 10,500 voters in the seat have signed a recall petition to remove Peter Bone, who's been censured by Parliament over acts of bullying and one act of sexual misconduct, all of which he denies. Now, Labour squeaked into the seat in their 1997 landslide. You wouldn't call it traditional Labour territory. Bone regained it for the Tories in 2005 in another tight election. But over the last few years, he's built up his majority to now 18,500. That equates to about a 35% majority over Labour. Now, this is the kind of seat which, to win at the general election, Labour would really, really need to be in landslide territory. But this is not a general election. This is the by-election. And Labour have overcome much bigger majorities than this in the last year or two. So Labour will really fancy their chances with this one.
Yeah, they fancy their chances, and maybe they've got a chance after the many seats they've managed to turn over out of those 20 with landslides. But how much does it matter, Ewan, if we're going to have a general election at some stage next year, judging by the inflation data?
I think it matters because it's part of the narrative, isn't it? The narrative is that the Tories are losing and Labour is gaining. It's just part of that kind of march forward by the opposition. You remember when Jeremy Corbyn was Labour leader, they really struggled in by-elections. That added to the narrative that he wasn't a winner. So this is all really useful stuff, I think, for Keir Starmer in cementing his place as a winner.
I wonder what the messages are going to be. I think actually the thing from the by-election that fascinates me the most is, a couple of months ago, 6 months ago, we were easily talking about this purely being a general election based on the economy, right? How do people feel in terms of their pay packet, their wages, their taxes? Maybe it's moving towards other issues. I mean, immigration could be one, the small boats issue, the NHS and so on. This, of course, is an MP, Peter Bone, pro-Brexit. I mean, he served under Boris Johnson sort of briefly. And so I wonder what the messaging for that by-election campaign is going to be. Also from Labour, might give us more clues about what's in the pipeline from Labour.
It's interesting that you should cite stopping the boats and cutting the NHS waiting list, two of the other targets of Rishi Sunak's, of course, alongside halving inflation by year end. Apparently, at the cabinet meeting yesterday morning, Rishi Sunak was marking his own homework on his performance through the year against his 5 targets that he set out in January. He gave himself a 4 out of 5, which is a bit of a head scratcher when you think that the only one that he's actually managed to achieve resoundingly, fair enough, is halving inflation. He's more than done that. But on the rest of the targets, he's really in the doldrums.
Growing the economy, that's a pretty tricky one to
NHS waiting lists are definitely higher than the started. Yeah, that's just a plain fact.
And he was at the liaison committee yesterday, the blockbuster committee usually, where you have the heads of all the different parliamentary select committees quizzing the Prime Minister. He was asked, when are you actually going to stop the boats? And he wouldn't put a date on it. And he refused to acknowledge whether or not commercial airlines have said they won't fly asylum seekers to Rwanda. So it looks pretty unclear on that.
So something that the government does want to do better on, and actually could also help to grow the economy, and that obviously the City of London is hugely interested in, is the health of the UK stock market. It's been looking, Lizzie, absolutely peaky this entire year, if not longer. But the financial regulator has been setting out what it is calling the most far-reaching reforms for the stock market since the 1980s, basically in the hope of changing all of that.
Yeah, the 1980s means Margaret Thatcher, Big Bang translation.
Yeah, and also we covered Jeremy Hunt, the Chancellor, telling us last year about Big Bang 2.0, although that name got quite swiftly dropped. So we wanted to ask the Financial Conduct Authority's Executive Director, Sarah Pritchard, how these reforms are going to change things.
I think it's the package as a whole. It's a simplified regime with one main category. If you're a company considering where to list, do ask your advisors and take a look at our proposals. We want you to consider the UK as an attractive proposition, and this is a much more simplified regime that should be easier to understand with fewer frictions, particularly for those companies that are in a growing phase.
Now, before we get bogged down in the nitty-gritty of the details of this regulatory change, let's speak to our finance reporter, Will Shaw. He's here to break it all down for us. Will, how are these changes going to actually make companies want to choose the UK over New York?
I think one of the key things to say about this is it comes against an atmosphere of general gloom around the UK's financial reforms and listings in general. So for about a year, the government has been touting really loudly its so-called Edinburgh reforms, which are intended to boost competitiveness after Brexit. Earlier this month, the Treasury Committee said formally that those reforms were feeling like a damp squib. That's a cross-party committee run by a Conservative lawmaker. So there's general concern around that. Then on listings, we've seen only a handful of companies have listed in shares in London this year, despite several attempts to shake up the market a bit and encourage more fundraising. Now, the most prominent one of those is Cambridge-based technology company Arm, which chose New York for its return to the stock market after its owner, SoftBank, spurred calls by the UK government for a dual listing. So I think there's a general sense of pessimism around this. I think you can hear that a little bit from Sarah Pritchard's remarks. She's keen to stress what the FCA is doing, but urging others to help, basically. She's pointing to much wider reforms. She talks about a public debate needed around areas including skills, workforce and tax. So there's a sense that things need to go much deeper than the proposals that have been announced this week.
Yeah, absolutely. I mean, that's a pretty big tell, isn't it, when you're calling on basically everybody else to get in there to try to change things. Let's go back, though, to Sarah Pritchard, because we did ask her if these changes would actually really lead, Will, to that big bang, to a big change for the City of London. Have a listen.
So we hear a number of comments around issues that make the UK potentially less attractive for companies seeking to list. The regulatory regime is one of those aspects, but there is a broader public debate around investor familiarity with certain sectors, around peer location, around skills, workforce and tax. And what we're very clearly setting out today, we want to make sure that the regulatory regime is appropriate, that we've got the balance right. We absolutely want to hear from stakeholders from all sides of the market, but we're clear that we're part of a much broader ecosystem, and our changes alone are an important contribution to updating the regime so that it's fit for the future, but others need to play their part too.
Does this get over the shrinking universe of listed companies in the UK? We've had outages that have disrupted trading in London. The FTSE 100 is the worst performing benchmark in Europe this year. We've only had 11 small companies that have begun trading in the UK. That is the enormous list of problems. You know it, I know it. All investors out there in London understand this. Is this going to be the set of reforms that's going to make the difference?
We believe we've got an important role to play, but we are part of a much broader ecosystem. So our reforms are an important element of ensuring that the UK, to support UK competitiveness and growth, but there are others that need to play their part too. The other focus today, we are announcing a broader set of measures to strengthen wholesale markets, strengthening wholesale markets being one of our key priorities at the FCA, and setting out new rules for a framework for a consolidated tape. So that's a single data source that will provide investors with trade and sales data quicker and more cheaply, starting with bonds. So we, as the Financial Conduct Authority, are engaged in a much broader programme of regulatory reform. We believe, having heard feedback, we've taken detailed feedback since consultation earlier this year on reforms to the listings regime, and this is our moment to seek the final feedback on whether we've got the balance right.
Well, interesting that Sarah Pritchard there from the FCA mentioning the much broader ecosystem. This is just one tweak of the rules, isn't it, when it comes to companies listing in London? But isn't the fundamental problem that just in the last few years, London has become very cheap? Companies that list in London are valued at much, much lower multiples than the ones listed in New York. And that is very difficult to fight, isn't it?
Yeah, I mean, I'm reluctant to make a call on whether these reforms might succeed or fail. I mean, a skeptic might say the issues that the UK challenge, the issues that the UK faces run much deeper than anything that can be resolved with a tweak to the listing rules. I mean, the thing to do will be watching the listings. Do the numbers of listings in London increase, and when? A good barometer for that might be watching ARM. I mean, we know that the Financial Conduct Authority offered ARM certain modifications to its listing rules as part of an attempt to bring it back to the London market. I mean, that was from the head of the Financial Conduct Authority in March. Now, we know that ARM are taking this seriously. So earlier Tuesday, the founder of SoftBank, which owns ARM, and ARM's boss were both pictured at Downing Street. Now, we don't know what was discussed. We don't know what the context of that is. But it seems like a fair assumption that their presence there is somehow connected to ARM's future in the UK. So that will be, it sort of suggests they haven't totally written off the UK. They are engaged. They're preparing to come here. They're preparing to meet like very senior officials. I think they are the ones to watch to see if these reforms have cut through to the wider market.
Well, thanks for being with us. That is our finance reporter, Will Shaw then. Look, I think this is really a very important moment, isn't it? We understand how difficult things are for the London stock market at the moment in terms of trying to attract companies to basically sell shares here, try to get investors to want to invest into companies that could eventually grow the UK economy. So I think there's a lot of scepticism about what the government is doing. And yet, on the other hand, if solutions are offered, right, to give it some leeway to kind of reserve judgment until we see what the real results are.
Yeah, because it matters for the government, because it kind of is used as a reflection of Brexit and how successful it's been. But also, we've had such a tightening of regulations after the financial crisis that maybe some are asking it's time to loosen the rules a bit and get London going. Because when you think about the companies that are listed on the FTSE, a lot of them are really old. And then if you think about the companies that are listed in America, I'm going to say this for myself, lots of them have existed since after I was born. So it's a very different situation here and there, and this is the FCA trying to change it.
Yeah, of course, London's dominated by natural resources, mining companies, oil companies, and banks. And as you say on the New York listings, there are loads and loads of tech companies which are all worth a lot of money, so it does make us look rather old-fashioned. Now, look, London was a hugely important stock market for such a long period of time, but just in the last few years, it has really declined. And Mumbai overtook it in 2021, and even Paris overtook it as Europe's biggest exchange last year. So it is a really quite intractable problem.
Yeah, well, at least for now, though, government trying to come up with some solutions, or the regulator is at least. We shall track them for you. Important for the economy of London, also for the whole of the UK. That's it from us, though, for today. If you like the programme, don't forget to subscribe. Give it 5 stars so that other people can find it on Apple Podcasts, Spotify, or wherever you listen.
This episode was produced by James Walcock, and our audio engineer was Max Green. I'm Yuan Potts.
I'm Lizzy Burden.
And I'm Caroline Hepker. We'll be back with more tomorrow. This is Bloomberg.
Bloomberg UK Politics. Listen weekdays at noon on DAB Digital Radio in London.